In today's video, I am going to be breaking down my high dividend stock portfolio for 2022. These are stocks that will give you a high dividend, but also should have potential growth throughout this entire year. Some of these stocks I do own already, while others I do not own as of yet. Anyways, let's get down. Let's check these out. So first, we are checking out a stock that I do not own as of yet, but I am looking at adding very soon to my own portfolio. It currently pays a 5.7% dividend, which is quite high for an individual stock, and its PE ratio is 29, which versus other companies doing very similar stuff, TransAlta's 29 PE ratio is really not all that bad. It also has an average volume of 440,000 shares traded every single day, so it should be quite easy to get in and out of as well. Now, its 5-year chart is quite interesting. As we see throughout 2018 and 19, it was basically starting to climb through 2019, and then of course the pandemic hit. And when that hit, it really didn't go down as far as I really thought it would. It was really only about a $6 drop from $17, and I was really expecting it when it was going down to hit the low point that it hit back in the end of 2018. But it did not do that. And then since that point, it has climbed to a $22 stock, which is huge, and it has recently pulled back really nicely, I guess you could say. It's actually looking very potential, like right now, to buy, at least in my opinion. One thing about TransAlta is they do have a high dividend, but they don't tend to increase it very often. In fact, the last time they raised their dividend was back in 2017. Something that is nice, however, is they do pay a monthly dividend, so every month you are getting paid by this stock. The one thing that does slightly concern me is the fact that they do have lower revenues and lower earnings. Lower revenues, not by a ton, like by barely anything in perspective, but their earnings are dropping, which is kind of concerning to me, and they've also had 4 missed quarters. However, what they are in is something that I believe is going to be a massive part of the future, which is they are in renewable energy, power generation facilities. As of March 3rd, 2021, it owned and operated 23 wind facilities, 13 hydroelectric, 7 natural gas, 1 solar, and 1 natural gas pipeline, and 1 battery storage comprising of an ownership interest of 2,500 megawatts, which is absolutely amazing. And those are the provinces as well as countries that it currently operates in. And I personally believe that this could be a massive part of 2022. We've seen from the Environment Minister of Canada, who I extremely disagree with, that he wants to make it so that fossil fuels are illegal within 2 years, which means that pretty much any station when it comes to anything with gas is going to be gone, apparently. So for you driving anywhere, then that's not going to happen. It has to be electric cars in 2 years, according to this idiot. So from there, basically that means that there's going to be a lot more electricity needed on the grid, and companies like this are going to be getting an arm and a leg from the government, because who's going to pay for it? The taxpayer. And of course, going along with the whole renewable energy sector, that's going to be also Enbridge. Now, you may be a bit surprised because they do oil pipelines and all of that other stuff. However, I have a feeling that they knew what was coming because they've gotten also into renewable energy. But first, they trade at over 9 million shares per day on average, which is huge. They also have a 6.5% dividend, again, which is huge. A lower PE than TransAlta, and in my opinion, they're kind of similar companies. So actually, versus other companies in the same sectors, Enbridge has one of the cheaper PE ratios. Their chart also doesn't exactly look fantastic. It's trading kind of in the middle of its long-term, at least 5-year chart. So it could be a good, interesting area to purchase some shares. I do own Enbridge myself. And the reason why I got into it was because I thought it would be a 10-year play for renewable energies, and they've really gotten into that sector. And now we've got this idiot in government who wants to make fossil fuel cars, and pretty much anything else that runs on fossil fuels illegal. So from there, this may actually take off if this idiot keeps on getting his way. The other nice thing about Enbridge is they do raise their dividend really often, and when they do raise it, it's usually substantial. Now, of course, this 2.5 cent raise was not substantial. However, the 7-ish cent raise beforehand was also pretty substantial, and the 6 cent raise there, which was equal to almost 10%, is pretty substantial. They've only had one bad quarter, 3 good quarters. They had rising revenues and earnings before 2020. So, of course, a lot of people did get hit in 2020. So, while this may look bad, I'm going to wait until the 2021 and 2022 numbers come out to make a full review of their actual financials, but I'm not really too worried about a company doing poorly in 2020. And this is the Enbridge website, and this is what I am talking about. Renewable energy, right there. They own a lot. They own a ton, and a lot more than what you may actually think. Fortis is another fantastic option this year. They've had some fantastic growth over their entire history. And on top of it all, their volume is ridiculous at 1.5 million shares per day. And they do have a 3.6% dividend. Fortis is a very strong company. The one thing I really do like to see in a company is that their revenues are rising, not necessarily their earnings though, which is kind of scary in my opinion. However, I do like to see revenue rise because whenever revenue is rising, that means that they are making more business. Earnings are earnings. As long as they are positive, it's always good. However, more revenue means potential few years from now, maybe even higher earnings, which is what we really want to see. They've had 2 good quarters, 1 miss, and of course 1 met expectations. Now you may be wondering, what does Fortis do? Well, Fortis operates an electric and gas utilities company in Canada, the United States, and the Caribbean countries. It generates, transmits, and distributes electricity. Notice how this is a very, very, very big part of my presentation, my video today, electricity. Because this is going to be huge in the future. If more and more of these environmental people keep on getting into government and say we cannot drive regular cars anymore, which I will be pissed because I have a Mustang that I like to drive. If we can't drive those cars anymore, then guess what? It's all going to be electric cars. What happens when we have all electric cars? There's going to be a ridiculous amount of infrastructure that needs to be put in because there's not enough infrastructure as there is right now for electric cars. So when that happens, a lot of the government spending is going to be thrown into these electrical producing companies. And whenever the government gives money to a business, the business will 10x up their quotes, because guess what? When it's government money, it's free, which means that they can charge whatever they want and the government will pay for it, and it can take however long it wants to take because the government will just keep on funding it. So guess what? These businesses are probably going to explode if the government starts funneling even more money to them, especially the idiot that we have in our environmental minister's office right now. However, their stock 5 years ago was under $42 a share and is now sitting at close to $60 a share. Of course, the downturn during the recession, and then of course it did hit that double point again. However, since then it has rose above its long-term, or at least 5-year trading average, or at least top point. It may drop a little bit lower. However, at the same time, this seems like a fantastic area to purchase the stock. They do pay a quarterly dividend. However, check out how they raise their dividend and how often they do it. It's fantastic. See, the one thing that I really like about businesses is if their stock price continues to go higher than regular inflation, and of course, if their dividend also rises higher than inflation as well. If that's a nice combination in your eyes, then this is also a fantastic business to invest in. The next stock is BMO. Now, overall, there's going to be a few different Canadian bank stocks in this portfolio, or at least in this video. The reason behind that is because they are making an arm and a leg during a recession when interest rates are basically zero. That means that when interest rates rise, guess what happens? Banks make more money, because if the interest rate is higher, that means that they make more money on the money that they already have. And when that happens, guess what? Their earnings go up again. So now they have been able to make money, all of the banks, they've been able to make money during a recession when money is cheap and they're not making any money on their money. They're making money. How they did it, how they are breaking earnings records, is because they charge money for everything. For ETFs, or for mutual funds, for a bank account. It doesn't matter how poor you are, you have to pay for a bank account. You have to have a lot of money to be able to not pay for a bank account. And guess what? Even if you are not paying for a bank account, they're still using your money to loan out 10 times over again, just so that they can make more money 10 times over on the money that you already have, that you're basically giving them for free to hold on to safely. So banks are making a killing. And then there's credit card charges. And then guess what? When interest rates go up, they make even more money. They've figured out how to make money no matter what time of the year and no matter what the economy is really doing. Their dividend is also 3.6%, which is fantastic. Average volume of 2.1 million shares traded every single day, and their stock has been on a virtual tear. Their PE ratio is one of the highest, however, in Canada when it comes to the big six banks. There's Royal Bank as well as TD that are in the 13 range. This is close to the 13 range. It's 12.8. However, the reason why this bank made my list is not because it's got a somewhat lower PE than TD or Royal Bank, because that's how I invest in the Canadian banks, is to try to aim for the lowest PE versus the rest of them. However, normally I wouldn't be looking at BMO because their PE is in the top 3 of the 6 banks. I would normally be investing in the lowest 3 PE ratio for the big 6. However, when I'm looking at BMO, they just made that massive purchase down in the States, which will be bringing them even more revenue. So that's actually the reason why I picked them for this portfolio. We can see that it was a fantastic time to purchase any time during that time, because the stock was virtually just trading sideways. And then it had a double bottom during the pandemic, and since then it has literally skyrocketed to the moon. It was trading basically at $100 for many, many years. And now, since that big drastic fall, it has really gained a lot of momentum. And something else I really want to point out is the MACD. Guess what? While this is rising, from this point to this point, the MACD was actually falling while this was going up. To me, that tells me that this could have a little bit more movement to go. They do raise their dividends quite frequently. However, do keep in mind that when it comes to their dividend, they were not allowed to raise their dividend for a while. Their next dividend is going to be a 25% raise on the $6. So keep that in mind. There is a massive dividend increase coming very soon. We just were not allowed to raise their dividends during that time. And this is what I mean. If you can keep your revenue super high and, of course, grow it during a recession, and then you can drastically grow your earnings during that time, have 4 beats in a row, you're doing extremely well. Now, CIBC is another one of my picks, a little bit lower of a PE ratio in the bottom half of at least PE ratios for the big 6 banks. It has a 3.9% dividend. Remember, the dividends are increasing very, very soon by the end of the month. And their average volume is 1.5 million shares traded per day. Again, traded pretty much sideways, slightly down actually before the massive downturn, but since then has absolutely been killing it. It was trading between $120 and $100 a share before this drop, and then of course since then it has gained massive momentum, up $65 from that low point here and up drastically from the pandemic low. And that is that massive dividend increase that they have had recently. Again, growing their revenue, growing their earnings. Had a miss on one quarter, but 3 beats. This is another one of those Canadian banks, yet again, 11.3 this time for the PE ratio, 3.4% for the dividend, 1.3 million shares traded. I'm just going to go through this really quickly, but this is a bank that I've been investing in for a long time because it had a low PE ratio and it was growing its business while all the other banks were trading sideways during that same time period. It's still growing its revenue as well, which is exciting. And guess what? It's had a little bit of a pullback, which means we should probably look at it seriously. Again, this one did raise its dividend massively as well, and it's one of the few banks to not do terribly in 2020, so that's promising too, and 2021 was just absolutely stupidly ridiculous. BNS, Bank of Nova Scotia, another one that I do own. PE ratio is a bit higher, closer to 12, but it's still in the bottom half of the Canadian 6 banks. 3.9 million shares traded on average. As of right now, the MACD on the chart has crossed a while ago. That's why we see this big uptick here. And this doesn't look to be crossing anytime soon, over at least the next couple of days. So this could have a little bit more acceleration going over the next couple of days, maybe a week or two. Usually I do not recommend buying near the top. I always say just wait for a little bit of a pullback. Usually that happens. Now, of course, they have not been allowed to raise their dividend recently. However, for their next dividend, they did increase it quite substantially from 90 cents up to $1. So keep that in mind. I hope that this video helps you with your investing journey. Remember, don't trust any random person online. I could have my own motives and other people could as well. So always do your own research and know what you're investing in. I hope that you've enjoyed. I'll see you guys again next time.